Welcome to the Pro Ticker Deep Dive.
Today we are opening the vault on the global banking system. If you're paying attention to finance anywhere between, say, 2019 and 2025, you watched a complete financial roller coaster.
A roller coaster is a good way to put it. We saw this monumental shift, right? Driven by all that pandemic-era liquidity, followed by the fastest, most aggressive interest rate reversal in, what, a generation?
Oh, easily. And so our mission today is to give you the blueprint on how that volatility has, fundamentally changed bank profitability and stability as we head into 2026.
Okay, so this isn't just a look back. It's about understanding the new structural realities that are in place now.
Precisely. We've pulled apart the sources to focus on 5 core indicators of bank health that really define this new landscape. We're talking deposit betas, loan growth, securities portfolios, net interest margins, and of course, regulatory pressure.
And the big picture hook here, which I think is absolutely critical for understanding everything else, is that the system has transitioned. Banks have weathered this incredible storm, but that highly lucrative, low-cost model that defined the last decade is, for all intents and purposes, gone.
It's gone. That's the structural takeaway. What's fascinating is that the high profitability we saw right after the 2022 rate hikes was what was temporary. Banks are now grappling with what our source material calls permanently higher funding costs.
And that one fact, the higher cost of money, that's the thread that weaves through everything else we're going to analyze today.
It dictates everything. Investment strategy, lending strategy, future regulation, all of it.
Perfect. So let's dive straight into that funding cost issue. That means we have to start with the surge in deposit betas.
Right.
For anyone who needs a quick check, think of the deposit beta not as some complex equation, but as how quickly your bank shares the central bank's rate hikes with you, the depositor.
Exactly. If the Fed raises rates by a full percentage point and your bank only raises your savings rate by, say, 1/10 of a point, that's a very low beta of 0.1.
And what shocked the system was how quickly that beta soared. We're talking levels not seen since before the 2008 crisis.
It's a profound shift in consumer power.
Yeah.
And the speed of it, particularly in the U.S., was just wild. By mid-2024, the cumulative deposit beta for all banks had hit about 0.51 or 51%.
Which is a huge catch-up from basically zero in early 2022.
A massive catch-up. And we saw a huge divergence early on. The massive U.S. banks, the too big to fail institutions, they were swimming in deposits.
From all the pandemic relief and QE?
Right. So they kept their rates low. They deliberately chose to let what they called hot money walk. They just accepted deposit outflows rather than paying higher rates.
Wait, hold on. Why would you deliberately choose to shrink your balance sheet instead of just paying up a little to keep the cash?
Because the cost of that cash was astronomical compared to what they're used to paying. They figured, they had enough liquidity to spare. But the regional and community banks, they didn't have that luxury.
They felt the pressure immediately.
Immediately. They were forced to offer much higher rates, driving their betas way up, sometimes approaching 80% for certain accounts. That cost imbalance created real stress points.
And in Europe, it was a totally different story, at least at first. Much more sluggish.
Very sluggish. Between mid-2022 and early 2023, the gap between what they paid on term deposits versus, say, your basic checking account was enormous. Overnight accounts barely budged.
Why? Were they just complacent?
Initially, yeah. It was attributed to European banks being simply flush with cash. They had no immediate incentive to attract more deposits. But the moment that liquidity recedes, which it's doing now, that competition is intensifying fast.
So the core driver here, the permanent shift, is competition. We're talking online banks, fintech platforms, and especially money market funds.
Money market funds are key. They offer yields sometimes approaching a 1.0 beta. If you can move your cash with 2 taps on your phone to a fund yielding 5%, why would you keep it at your bank for 0.1%?
You wouldn't. And that digital awareness, amplified by social media, creates instant stability risk.
It's a direct line to what happened in March 2023 with those U.S. regional banks. They assumed deposits were sticky, only to find out that in a crisis, depositors are highly rate sensitive and incredibly mobile.
So the big takeaway for 2026 is that this high beta environment is here to stay. It's structural. Even if rates fall, betas will stay high. That golden era of cheap deposits is over.
It is, which means banks are under enormous pressure to generate profit elsewhere, and it usually means loan volume. Which brings us to our second area, loan growth.
Which has seen its own extreme whipsaw. Strong post-pandemic growth was immediately choked off by high rates in 2022 and 2023. U.S. loan growth fell from around 6% year over year down to, 2-3%?
In that range, yeah. And housing finance was effectively frozen. Mortgage originations for single-family homes in the U.S. roughly halved when rates pushed past 7%, a dramatic freeze-out.
But our sources point to a fascinating positive surprise in late 2025. U.S. bank loan growth saw a 2.1% quarter-over-quarter increase in Q2 2025. That's the fastest sequential growth since 2022.
It is, but the devil, as always, is in the details of where that growth is coming from.
Okay.
A significant chunk of it was driven by large banks lending to non-depository institutions. Think private equity funds, specialty lenders, that sort of thing.
So not Main Street. They weren't lending more to homeowners or small businesses. They were funding other parts of the financial system where they saw an opportunity.
Precisely. Now, if we look at those traditional segments, commercial real estate, or CRE, is definitely a soft spot, a significant risk, especially for the regionals.
I would have thought that after the 2023 failures, banks would be running from CRE.
Well, the risk hasn't vanished. It's just contained differently. The real challenge is the sheer volume of loans maturing in 2025 and 2026. They all need to be refinanced in a much higher rate environment, often against assets like office buildings that have dramatically lower valuations.
So banks are trapped. They need to lend for growth, but they have to be incredibly selective about which CRE loans they'll touch.
Exactly. They're favoring safer segments like industrial and multifamily housing. So overall, CRE volumes for many banks might actually stagnate as they let risky assets just mature off their books.
And on the consumer side, we saw U.S. credit card balances break the $1 trillion mark, which sounds great for banks, but even that's stalling out.
Yes, the source material notes that balances actually declined by almost 3% in early 2025. And this wasn't just consumers paying down debt. It was banks tightening underwriting standards because of rising delinquencies.
So they're pulling back on credit limits.
They are. We expect that whole segment to see flat to maybe low single-digit growth going forward.
Which means the biggest hope for 2026 volume is really the mortgage market.
That's the anticipated gentle rebound. The Mortgage Bankers Association is projecting an 8% increase in single-family originations for 2026, about $2.2 trillion. But, and this is a big but, it assumes central banks ease policy.
Right, which would bring mortgage rates down a bit. Globally, what's the picture?
The forecast is for global bank lending to accelerate from a low of about 2% in 2024 to maybe 6% in 2025, again, assuming that policy easing happens.
But growth is still going to be a fight.
A tough fight. Banks are facing intense competition from private credit funds, especially in corporate lending. These funds are less regulated, they're nimbler, and they're capping how fast traditional bank C&I loans can expand.
This need for disciplined lending brings us to Section 3, securities portfolios. This used to be the most boring part of a bank's balance sheet.
And then 2023 happened, and we learned it can be the single greatest systemic risk.
It was a textbook setup for disaster, wasn't it?
A complete textbook case. In 2020 and 2021, banks were flooded with those cheap deposits, but loan demand was sluggish. So they did the natural thing. They parked trillions of dollars in long-term bonds, often yielding only 1 or 2%.
Accumulating a massive amount of duration risk.
A huge amount. And then when rates jumped in 2022, the value of those bonds just plummeted. The peak of the damage was, well, it was terrifying. Unrealized losses on U.S. bank securities hit about 12.2% of the total portfolio value in Q3 2023.
We're talking, what, $600 or $700 billion in total losses?
In that ballpark, yes. And that, of course, was the core trigger for the collapse of Silicon Valley Bank, Signature, and First Republic.
They had deposits fleeing, and if they had to sell those bonds to get cash, they'd realize those crippling losses and wipe out their equity.
Exactly. Their so-called safe investment portfolio was deeply underwater. The operational mistake was assuming those deposits were sticky when digital tools made them anything but.
So how did banks pivot after that crisis? We have to get into the AFS versus HTM distinction here, which can be a bit technical.
Let's simplify it. Banks have two buckets for bonds. Held to maturity, or HTM, means you plan to hold them forever, so you can ignore temporary price drops. Available for sale, AFS, means you have to mark them to market.
So the losses show up on your balance sheet?
But that portfolio is much more liquid. You can sell from it. And the strategic shift was all about liquidity. U.S. banks cut their HTM portfolios for 10 straight quarters. They shifted massively toward shorter duration AFS securities.
So where do those losses stand now? Have we fixed the problem?
They've roughly halved, which is a big relief, but they are not gone. By Q2 2025, unrealized losses were down to 6.8% of securities, around $337 billion. The good news for 2026 is, if rates decline as expected, these losses will shrink further.
But the long-term lesson is just stricter risk management.
No question. Banks are shorting duration targets, they're hedging more with swaps, and critically, new U.S. regulations are coming. They will force large banks to include those AFS losses directly in their capital calculations.
So they can't take that kind of duration risk ever again?
Not without paying a huge capital penalty for it. It forces structural conservatism.
Which brings us perfectly to Section 4, net interest margins, NIMs, the engine of bank profitability. We've seen it go from a bonanza to a serious squeeze.
The rising rate environment created this temporary, incredibly lucrative windfall in 2022 and 2023. European NIMs jumped from 1.1% to over 1.5%.
And this was because they were quick to raise loan rates but slow to raise deposit rates. That low beta we started with.
An asymmetrical profit bonanza. But that asymmetry vanished as deposit betas caught up. The compression began in late 2023 because those relentless funding costs started to eat away at the spread.
And now we're seeing some divergence. Large U.S. banks saw compression in Q2 2025, but some smaller banks actually held up.
They did, probably those with very sticky, loyal core deposits. But for the system as a whole, that period of easy widening margins is over.
And now comes the real challenge for 2026, the falling rate trap. When central banks cut rates, loan yields drop quickly.
But banks are terrified to cut their deposit rates just as quickly on the way down. They fought so hard to win those deposits back from money market funds, they fear losing them again immediately if they drop their rates too fast.
So you get a low beta on the way down, which is the opposite of what you want. The margin gets squeezed from both sides.
Exactly. So if NIMs are normalizing back toward pre-2022 levels, future profit growth has to come from sheer volume, not from wider margins.
And disciplined cost control.
That's the core strategic adjustment. One EY projection says that even with margin pressure, net interest income, the total dollar profit, will resume growth, maybe 3% in 2025, specifically because loan volume is finally picking up. They have to be disciplined balance sheet managers now.
Which perfectly sets up our final section, regulatory pressure. What's forcing all this discipline?
It's a dual mandate. The final implementation of the Basel III reforms, the endgame, and the harsh lessons from the 2023 failures. Regulators are plugging every single hole they found.
And the critical U.S. change is lowering the threshold for the strictest capital rules. It's moving down from banks with $250 billion in assets to just $100 billion.
That new rule set is huge. It requires including those unrealized AFS losses we discussed directly into capital ratios. Regulators estimate this will result in an aggregate 16% increase in Common Equity Tier 1 capital requirements for the affected banks.
16% is a massive jump. Who gets hit the hardest?
The global systemically important banks, the G-SIBs, see the biggest hit, about 21%. But the real story is the regional banks in that $100 billion to $250 billion range. They face about a 10% capital increase, plus a huge increase in compliance burden.
So you're putting a ton of pressure on that middle tier. They're moving from a lighter regime to one that demands almost G-SIB-like compliance and capital.
Exponentially increasing their cost of doing business.
Yeah.
And it's not just capital. Stress tests are being enhanced. They will explicitly include scenarios testing severe interest rate shocks and critically idiosyncratic liquidity runs.
They're basically simulating an SVB-style bank run.
To make sure it can't happen again. So ultimately, regulation is demanding higher quality capital and better liquidity. The system is safer, but it's also much more expensive to run.
And analysts estimate this could shave a few percentage points off bank returns on equity. The system is more resilient, but permanently constrained on profitability.
That's the trade-off.
Okay, so to synthesize all 5 threads, high deposit costs and the need for liquidity-constrained investment strategies. Normalized NIMs mean growth has to come from safe loan expansion. And higher capital requirements mean banks have to be extremely discerning.
It creates a new landscape for 2026 where resilience and risk discipline are prized above, maximum short-term profit. The whole system has fundamentally changed how it manages money.
That leaves us with a provocative thought for you to consider. Given that depositors are now highly rate sensitive and digitally empowered, and regulators are forcing banks to hold high liquidity buffers, is the traditional core deposit advantage of large banks, the very thing that fueled that NIM bonanza, now permanently neutralized.
It raises some very serious questions about the strategic value of just being big versus being specialized in this new era.
See y'all in the next ProTicker Deep Dive.